Now that we have calculated WACC, we can discuss the two methods used to estimate terminal value. Remember, most DCF models have a discrete forecast stage and a terminal value stage. The first terminal value estimate we discuss is usually known as the perpetuity growth method. Basically, we take the last forecasted unlevered free cash flow and we grow it for 1 year at some perpetual growth rate. The perpetual growth rate is usually based off the long-term nominal GDP growth rate of a mature market economy, usually around 2 to 4%. Basically, we assume that all future growth in the terminal value comes solely from economic growth. Once we calculate that perpetual cash flow, we divide that perpetual cash flow by WACC minus G. This captures all of the value after our discrete forecast stage. Again, remember that we still have to discount this terminal value back to the present value. The second method for estimating terminal value is by applying a valuation multiple, which we will discuss in more detail later in this course. Basically, we assume the target company will be acquired at the end of our discrete forecast at some multiple. Since we are performing an unlevered DCF, we want to use an enterprise value multiple, the most common of which is enterprise value to EBITDA. To calculate the terminal value under this method, we simply multiply our last forecasted EBITDA by the enterprise value to EBITDA multiple. This is known as either the terminal multiple approach or the exit multiple approach. Just like under the perpetuity growth method, we will need to discount this terminal value back to the present value. One thing to note, while we might discount cash flows as if they occur in the middle of the year versus the end of the year, we always assume the terminal multiple approach happens at the end of the year. Lastly, the terminal value makes up the bulk of a company's value. So we want to be very careful when selecting perpetual growth rates and exit multiples. Now let's look at an example and then calculate the terminal values in our model. So we've calculated the unlevered free cash flows in our main model, but we want to practice calculating terminal value in this exercises file, as there's a lot of confusion regarding terminal value. So we have a simple example, and we're going to calculate the terminal value using the perpetual growth method and another terminal value using the terminal multiple method. Both are widely used in practice. So we'll start by using the perpetual growth method. Okay. So we've already given you a series of cash flows and the number of years to discount. Let's go over and set up the terminal free cash flow section over here. Again, the gray shading is just an identifier for us to know what to work in. So with the terminal value, regardless of whether you're using the perpetuity growth method or the terminal multiple method, the timing is always the same as the last year's timing in your discrete forecast stage. Okay, so we're going to set that equal. And of course, you can see right here we have our discount rate and our perpetual growth rate. We need those. So we'll take our year 5 cash flow and we're going to grow it at that perpetual growth rate of 2% in this instance. Then in order to get the actual terminal value, we take that cash flow, divide it by our discount rate or WACC minus that perpetual growth rate. And we arrive at 133,302. Now, real quick, this captures all of the value after year 5. It is, in fact, a present value calculation to year 5. However, we still need to discount that back to the present value, not to its year 5 value. Okay, now let's calculate our total cash flows. In this terminal year, the cash flow is really just that terminal value we just calculated. Okay. And now we can present value each one of those cash flows. So we'll just take our cash flow divided by 1 plus our discount rate. Make sure you anchor it with F4, and then we'll raise it to the power of 1 because this cash flow is going to occur in 1 year. And now we can take these and paste them forward. Okay. And again, since the terminal year, we're discounting it for 5 years, it's as if it occurred in this year. Mathematically, it does. So again, that's the reason why we always want to link. Our terminal timing is always the last year or period in our discrete forecast stage. Now that we have the present value of our cash flows, we can simply sum those up and derive enterprise value. Now let's move down and calculate the terminal value using a terminal EBITDA multiple. So you can see we have our discount rate. It's the same discount rate as above, but in this case, we're assuming a 7 times EBITDA multiple. Okay, so let's set up the terminal value section. As always, again, the timing always corresponds to the last period in your discrete stage. Okay, and then we have EBITDA. Now, when we use the EBITDA multiple approach, we take the last year's EBITDA as our number in order to determine terminal value under this methodology. And the reason being is that we assume that at the end of year 5, the company is going to be acquired for some multiple of EBITDA. And so we use that year 5 EBITDA, the last 12 months EBITDA, in order to calculate our terminal value under this methodology. So now we can take our EBITDA and we'll multiply it by our 7 times EBITDA multiple to get our terminal value. Again, note there are no cash flows associated with this because the cash flows are already being accounted for in year 5. So we don't need to fill out anything there. Now we can simply present value the cash flows just like before. Divide by 1 plus our discount rate. Raise it to the years in which these cash flows will be received. Copy it forward. And then we can sum all the present value of all of those cash flows. And we have yet another enterprise value, in this case, $105,764. Again, I know I'm repeating myself a little bit, but regardless of whether you use the perpetuity growth method or the terminal multiple method, you still need to use the last year's timing. In other words, the terminal value calculation already discounts the terminal value back to the last year in your explicit or discrete forecast period. In this example, it's year 5. So that's why we set these equal. Okay. And another point on the terminal or exit multiple method. This method assumes the business will be acquired on the last day of the fiscal year. So this isn't a problem if we use end of period discounting for our cash flows. However, if we use mid-period discounting for cash flows, then we will have an inconsistency when using the terminal multiple approach, again, which is assumed to be at year end. So we've covered the two ways of calculating terminal value in a DCF. The first one using a perpetual growth rate, and the second using an EBITDA multiple or a terminal multiple. So we've given you enough information here. What I'd like for you to do is to calculate the terminal value using the perpetual growth rate, as well as calculating the terminal value using an EBITDA multiple. We've already practiced this in our exercise, so let's apply it in our model. So give it a shot. We'll come back and we'll walk through it together. Okay, now let's walk through this together. So we have 5 years of unlevered free cash flows, but we need to take the last year, in this case 2027, and we're going to grow it at 1 plus our terminal growth rate. Again, in our model, we assume 2%. Discussed earlier that a terminal or perpetual growth rate should be based on long-term nominal GDP of a mature market economy. Again, it's usually between 2 to 4%. So now we have a hypothetical 2028 cash flow. Okay? Calling it hypothetical because our model doesn't go to 2028, but you can think of that number, 10,977, as a 2028 number. But let's apply the perpetuity calculation to get the terminal value. So we divide that cash flow by WACC minus our perpetual growth rate. And we have the terminal value of 118. It's actually millions of dollars. Okay. Now let's go down and calculate the terminal value using the EBITDA multiple. So we need to pull in our 2027 EBITDA. So we can either pull it from our unlevered free cash flow, or we can pull it from the schedule above. We could even pull it from the income statement if we wanted to. But we'll take our EBITDA and we'll multiply it by a 7.2 times terminal multiple. And we get $158.5 million. Now again, just as a reminder, the terminal multiple method assumes the shareholders of the target company sell their shares at the end of the year. Again, this is not a problem if we are using end of period discounting. We're not at discounting yet, but we will very shortly. So it's not a problem if we use end of period discounting. But if we use, say, mid-period or the middle of the year discounting, then there's a mismatch in timing. Because again, the assumption is the terminal value or the terminal multiple approach is at the end of the year. Now, it's not that big of a deal because what we're going to do is we're actually just going to average the two terminal values together. So we'll reference the terminal value using the perpetual growth rate. We'll reference the terminal value using our terminal multiple, and we'll just average those together. We'll select those. And on average, you see it's about $138.5 million. Okay. Now, you may or may not see this averaging in practice. A lot of firms will average terminal values. Others are steadfast against it. In this case, we're just going to go ahead and average the two. So now that we have our unlevered free cash flows calculated, as well as our terminal values, we can now discount the cash flows to derive enterprise value. From there, we will subtract net debt to obtain equity value, then divide by shares outstanding to calculate what we think the company's share price should be. And we can compare that to the current market price. For now, we're going to assume all of the cash flows occur at the end of the year. So again, please attempt this. This will be a bit more challenging than the other calculations, but we will obviously go through it together. Okay, let's walk through this together. First step is we need to pull in our unlevered free cash flows. It doesn't really matter which method we use. We can pull it from one of these terminal value calculations, or we can pull it from our unlevered free cash flow calculations up above. So I'm just going to pull it from the EBITDA schedule. Again, they all match. And we'll fill that to the right. We need to pull in our terminal value, again, for simplification purposes. And you might see this in real life. We will use the average. And then we just need to sum up the total cash flows. So there are no terminal values in the years 2023 through 2026. But we still want to throw in a sum. Again, in that last year, 2027, we get the benefit of the unlevered free cash flows as well as the terminal value. We just want to make sure that we capture that. Okay. Now, our discounting period, again, as mentioned, for this analysis, we're going to assume that the cash flows all end at the end of the year. Okay, and we can do some Excel trickeration here. We can take the year 2023 minus 2022. Again, Excel just sees those as numbers. So 2023 minus 2022 equals 1. Now, note that I have anchored 2022 because when you copy it out, again, it's a 5-year forecast period. We still want to base our discounting off of 2022. Now we can calculate the present value of the cash flows. We can take our total cash flows, we can divide it by 1 plus our WACC, and then raise that to our discounting period, and then copy that to the right. But that can't possibly be right. The present value of cash flows must be lower than the total cash flows. So in year 5, you can see I have 149 million, which is what the undiscounted cash flow is. And that's because I forgot to anchor the WACC calculation. So we hit F2 to go into edit mode, F4 to anchor WACC. And now we can copy that out. Now it makes more sense. Now that we have the present value of our cash flows, those are all unlevered cash flows. So if we sum those up, we get enterprise value. Then we need to calculate our net debt. So we're going to go ahead and make that a negative number, but we'll have to go up to where a lot of that data is. So we'll take our debt of $20 million minus our cash of a little less than $6 million. And so we have total net debt of a little over $14 million. Again, we made it negative in this case, just so we could simply sum everything up. And we have an equity value of a little less than $106 million. Since we have total equity value, or what we think the total equity value should be, we want to actually calculate it on a per share basis. So we'll reference our equity value. We'll divide by shares outstanding. And we calculate an equity value per share of $6.19. The current price is $7.25. So let's just calculate the upside or downside. So the market price is saying this company is worth $7.25 per share. We just calculated $6.19. That's a 15% downside to the current market price. So again, we would probably not want to buy this stock. But of course, we will also use some relative valuation techniques to compare it to our DCF. Remember, value is inherently unobservable. So we use multiple different valuation methodologies to triangulate a value. DCF is just one of those techniques. So we've got a couple of others that we'll look at to see what we think that the true value of this company might be. So another type of analysis that we can perform is to calculate the implied growth rate when using the terminal multiple method. We can also calculate the implied terminal multiple when using the perpetuity growth method. For now, feel free to review these formulas. They're very complex, but we do cover the derivation of these formulas in the appendix to the course manual. Now let's take a look at some of the advantages and disadvantages of a DCF. Some advantages. Theoretically, the DCF is the most correct way to value companies or investments. Correct meaning that investments are only worth making if they eventually generate free cash flow. A DCF provides an opportunity to learn about the company and industry. Before we actually begin creating our DCF, we must have a thorough understanding of the target's business. In order to learn about the target company, we should review its financials and read any published research on the company and industry. A DCF is also less prone to market conditions since it's an intrinsic valuation, not a relative valuation. But some of the disadvantages, well, it requires a lot of inputs, and the model is only as good as those inputs. Given all of the inputs, it's easier to manipulate a DCF to a desired outcome. And the greater complexity of the DCF model may give an analyst a false sense of precision. Now let's talk about some handy Excel functions that can help when discounting cash flows. The NPV function is used in Excel to quickly calculate net present value. There are a couple of key assumptions when using NPV. 1. The NPV is calculated by discounting all cash flows. This is important as it makes it different from a very similar function. 2. Cash flows are assumed to occur at regular intervals, for instance, annually. 3. Cash flows occur at the end of the period. The NPV function syntax has the following components. 1. The discount rate. 2. Cash flow values for a certain number of periods that are equally spaced and occur at the end of the period. And while the NPV function is a useful tool in calculating the present value of a stream of cash flows, it's not entirely accurate when dealing with cash flows that occur sporadically over a period. Of course, in real life, cash flows don't typically occur at the end of the year. They occur throughout the year. So one assumption we often make in a DCF is to assume the cash flows occur in the middle of the year or mid-period. This will slightly increase the present value of those cash flows. But that presents us with a problem since the NPV function assumes the cash flows happen at the end of the period. However, there is a quick solution to this problem. To apply mid-period discounting using the NPV function, multiply the NPV by 1 plus the discount rate, with that taken to the power of 0.5 or half a year. So basically, we compound the cash flows at whack by half a period. This is equivalent to discounting the cash flows at the middle of the year. We've seen how to use the NPV function with and without mid-period discounting to calculate net present value in Excel. Another tool that can be used is the XNPV function, which can add even greater accuracy to the results, as it's not limited by the same assumptions as the NPV function, namely that cash flows occur at regular intervals. Instead, the XNPV function uses specific dates, that correspond to each cash flow being discounted. The XNPV formula syntax in Excel has the following components. 1. The discount rate. 2. Cash flow values for a certain number of periods. And 3. Dates that correspond to the periodic cash flows. It should be noted that the XNPV function does not discount the initial cash flow. This is in contrast to NPV, which discounts all cash flows. That being said, since XNPV does not discount the first cash flow, but we might need it to, then we would enter a 0 value at the valuation date. We will demonstrate this further in our DCF model. Mid-period discounting can also be easily applied when using XNPV. The function syntax is the same. All we have to do is to adjust the dates to the midpoints of their respective periods. For example, with annual cash flows, the midpoint could be assumed to be July 1st of each year instead of December 31st. Now let's take a look at a related concept, the internal rate of return. The internal rate of return, or IRR, is the discount rate that makes the net present value of an investment equal to 0. It is the expected compound annual rate of return that will be earned on an investment. Once the IRR is determined, it is typically compared to a company's cost of capital, sometimes known as the hurdle rate. In general, if the IRR is greater than the cost of capital, then the project should be profitable. If the IRR is less than the cost of capital, do not invest in the project. The IRR function in Excel returns the internal rate of return for a series of cash flows that occur at regular intervals. The IRR function syntax has the following components. 1. The cash flow values. These are a required element. The cash flows must contain at least one negative value, usually the first cash flow, and at least one positive value. Furthermore, the values should be in chronological order. The second argument in IRR is not required. The analyst can put in a guess, an estimate of what the IRR could be. If this is omitted from the function, Excel assumes it to be 10%, but again, it's not necessary to enter a guess. Similar to the XNPV function, where the timing of cash flows can occur at irregular intervals, the XIRR function can also accommodate non-periodic cash flows. The XIRR function has the following syntax. The first one is values. Again, this is a required element. The array of values must contain at least one positive value and one negative value, and the value should be in chronological order, just like the regular IRR function. The second argument is dates. This is also a required element, and the dates should correspond to the schedule of cash flows. The third and final argument is the guess. Again, this is an optional element. So this exercise is really about using the various NPV and IRR functions. However, we will start out by discounting cash flows using the manual method. Notice that we use periods for discounting in this method. Of course, we could make these periods more dynamic, but you get the picture. Also notice that these cash flows occur at the end of the year. To make sure that we don't discount the first year, we set the exponent to 0. Since we have all of the cash flows and the timing, let's go ahead and discount those cash flows. Again, this is the manual method. So you've seen this several times at this point. Again, the first year won't be discounted because the exponent is 0. So we have a present value of negative 20,000, which is proper because we do not want to discount that in this case. And we'll select our range, and then we'll just do Control R to fill right. And then we can sum up all of those discounted cash flows. And we arrive at 100,000, effectively $100,000. Now we will apply the NPV, XNPV, IRR, and XIRR functions. Notice that the cash flows are still at the end of the year. We'll start with NPV. Since NPV discounts all cash flows, we must exclude that first cash flow from the actual NPV function. Again, so basically we are assuming the $20,000 cash outflow happens today at time 0. We'll do equals NPV. First argument is your discount rate. Then we will select the range of cash flows, but we need to account for that initial cash outflow. Again, since NPV discounts all cash flows, and we specifically do not want that first cash flow discounted because it happens today, we'll just add it outside of our NPV calculation. And you can see our numbers match the DCF that we calculated previously. So we had to exclude that first cash flow when using the NPV function. We do not have to do that with XNPV, since XNPV does not discount that first cash flow. So let's enter our XNPV function. Again, it starts with the rate. Then we select our cash flows. Again, NPV or XNPV does not discount that first cash flow. But there is a third argument in XNPV that makes the calculation a little bit more accurate, and that is we select a range of dates. Close bracket, and we get 99,968. So it's pretty close to NPV, but it's a little bit more accurate. The reason being is because we're using dates, and it's taking into account leap years. But they are fairly close because all of the cash flows occur at the end of the year and are evenly spaced. Now let's go ahead and calculate the IRR and the XIRR. So IRR, again, in order to use the IRR function, we need a cash outflow and a cash inflow. So we have our initial cash outflow, which we select. We'll select all of the cash flows, and we derive an IRR of almost 79%. XIRR is similar to XNPV in that it takes into account the days. So we still select our values, and then we will reference the actual dates, just like XNPV. And again, you can see the IRR and the XIRR are really, really pretty close. The XIRR being slightly more accurate, again, because of leap years. And we can check these IRRs to make sure they are correct. Remember, IRR is the discount rate that sets NPV to 0. So if I copy the XIRR and just paste as a value in our discount rate cell, you can see XNPV 0. So 78.8% IRR does set XNPV to 0. Do Control Z to undo that, and we'll test IRR as well. So copy IRR, paste special values, Alt ESV, and you can see now NPV is set to 0. So the IRR calculations work perfectly. So in this last example, we changed the dates to make sure they were not at the end of the period and relatively sporadic. So in this case, once we fill in the functions, you can see how XNPV and XIRR diverge from NPV and IRR. To NPV first, again, reference the rate, select the cash flows, and then capture that initial cash outflow. So there's our 100,000 NPV, like in the other examples. But if we do X NPV, we still have to reference the rate. But in this case, we can capture all of the cash flows. Then we select all of the dates. And now we have an X NPV of 102. Okay. It's not that much different, but there is a difference. You do the same thing with IRR. So we'll do IRR, select our cash flows, and we get the 78.9% IRR that we did above. Now when we use X IRR, select our values, and select our dates, and you can see there's a pretty decent sized difference between XIRR and IRR. So bottom line, XNPV and XIRR are a little bit better compared to NPV and IRR. Just make sure that if you want to use XNPV and or XIRR, you must have properly formatted dates. In other words, you can't just use a year number like 2023 or 2024. You actually have to use the month, the day, and the year. So you've calculated enterprise value, equity value, and equity value per share using manual discounting. We're going to mix things up a little bit. We're going to calculate the enterprise value and equity value using actual dates, both on an end-of-period basis as well as a mid-period basis. We'll first do that manually, but then we'll use the NPV function to calculate the end-of-period enterprise value and then equity value. And then we'll use XNPV using both end-of-period and mid-period dates. Again, I've mentioned it before, but it bears repeating. XNPV does not discount the first cash flow, so we may need to hard code a zero value at the valuation date to obtain the correct present value. And we'll go ahead and show you that right now. We hard code that as zero. Again, XNPV does not discount the first cash flow. Since we have a zero in there, it doesn't matter. XNPV, assuming you get the date ranges correct and the cash flow ranges correct, XNPV will do the work and will discount everything appropriately. So again, try this out and we will walk through all of it together. So let's do this one together. Admittedly, this is the most challenging part of this DCF model. Okay, since we have actual dates that we want to use. So for our discounting period, yes, in theory, you could take 2023 minus 2022 if you wanted to. Alternatively, again, since we have actual dates, we can take the dates, one date minus another date. Again, we'll anchor that date in cell H245, and we'll divide by 365 for days in the year. Again, when Excel sees dates like this, it doesn't think in terms of dates. It uses serial numbers, but we can still do math based on it. And again, yes, I realize some years have 366 days. It's close enough for our purposes. Okay. But again, you still get 1 out to 5 years. Okay. Then we can present value the cash flows. Again, make sure that you anchor your WACC. And raise it to the power of the discounting period. Copy that to the right. Then we'll calculate the enterprise value. These are unlevered cash flows. So we'll capture those. And then for equity value, instead of having net debt and shares outstanding for each one of these calculations on this, in this section, we'll just do it all at once. So we'll take our enterprise value. And if you recall, net debt was negative, so we can add it. By adding a negative number, we are, of course, subtracting, but we'll anchor that. And then we need to divide by the shares outstanding, which we will also anchor. So now we have $6.19, which is what we had earlier. Now let's apply mid-period discounting as our convention. Again, up until now, we've been using the end of period or end of year discounting convention. But you'll notice up here we have cash flow timing. And you can see June 30th, we have a normal fiscal year of December 31st, so June 30th is the middle of the year. Okay, so we can do some similar math to what we did in the previous example. We take one date, subtract a previous date, divide by 365, and this will be 0.5. And we'll copy that out. Again, you'll notice everything is 0.5 earlier than the end of period. That's intentional. We are slightly moving the discounting forward, which will slightly increase the present value of our cash flows. Again, the underlying assumption in the mid-period discounting is that the cash flows don't occur at the end of the year. They occur on average in the middle of the year. Either way, though, take our cash flows, divided by 1 plus our WACC, raised to the half power in this case. Copy it forward. Sum everything up to get our enterprise value. And we don't need to include that 0 in cell H263. We really only need to factor that in when we start using the XNPV. And the equity value, since we anchored net debt and shares outstanding, all we have to do is we can literally just copy that formula and paste it like so. So again, the present value, the equity value per share is a little bit higher because we are moving the discounting forward. So our present value increases. You can see a higher enterprise value than in the end of period. Therefore, that translates into a higher equity value per share just through changing your discounting convention. Now let's go ahead and use the NPV function to calculate the enterprise value and, of course, the equity value. Again, the NPV function assumes end of period discounting. Do equal NPV. We need to reference our weighted average cost of capital. And then we'll capture the undiscounted cash flows. Press enter. And again, you can see that the NPV function using end of period discounting is very close to the manual end of period discounting convention. Once again, to get equity value per share, we can simply copy the formula again. Net debt's anchored, shares outstanding are anchored, and we get $6.19. Now let's go ahead and use XNPV. Remember, XNPV is maybe the best way of discounting cash flows. The only trick is you have to have actual dates. Of course, in this section, we do have actual dates. The first use of XNPV, we're still going to assume the end of period discounting. So do XNPV. And again, once you have your function selected, you can hit tab and it fills everything in. So we first need to reference our rate. Then we are going to capture the undiscounted cash flows. Again, the trick with XNPV is that since it doesn't discount the first cash flow, that's the reason why we hard-coded 0 in cell H252. Okay. So we select those cash flows. And then the third argument, XNPV, again, in this case, we're assuming the end of the year. We need to select the fiscal year end dates. Press enter. And again, it's basically identical to the manual end of period discounting convention. And on an equity value per share, also $6.19 as well. Now let's use the XNPV for mid-period discounting. So again, XNPV, first argument is our WACC, and we'll take our cash flows. Again, we need to make sure we take into account that zero cash flow. And then since we're doing mid-period discounting, we want to use the dates in row 246. Press enter. Again, the number matches our manual mid-period discounting convention. And calculating equity value, again, we can copy and paste. It's 658, which also matches the manual mid-period discounting convention. The reason why we do all of these is to show you the strengths and weaknesses. So you can obviously do manual discounting. You can use NPV. You just have to be aware that the first cash flow in an NPV is discounted. You can use XNPV, but the first cash flow in XNPV is not discounted. And you also have to make sure that you have actual dates when you use XNPV. So they all have their strengths and weaknesses, and we want to show you all of them at the same time. And finally, let's talk about calculating the internal rate of return. So let's assume we are investing $20 million to purchase this company. Since we have a negative cash outflow, we can calculate the internal rate of return using the IRR function as well as the XIRR function. So go ahead and calculate the IRR using, again, the regular IRR function. Use the XIRR function with end of period discounting, and then use the XIRR function for mid-period discounting, and then we'll walk through this together. Okay, so we'll start off by using just the regular IRR function. It equals IRR. And again, the IRR function requires one negative cash flow and at least one positive cash flow. So we'll select this entire range. We have a negative cash outflow to begin with, and then we have the cash inflows. Press enter, and we have a 78.9% IRR, which is an extremely healthy IRR. Now let's use the XIRR function, and we're going to assume the end of period discounting. So we still capture our cash flows first, and then we will grab our dates. And again, since this is the end of period discounting, we use the fiscal year end. So we select, again, our cash flows and then our dates, and we get 78.8. These numbers might look a little familiar based on the exercise we did earlier. Now let's try XIRR using mid-period discounting. So we'll do XIRR, again, select our values, and then in this case, we select these mid-year dates, just like we did with the XNPV mid-period discounting. Press enter, and whoa, all of a sudden we have a 101% internal rate of return. Whether you're doing mid-period discounting or end-of-period discounting or just using the regular IRR function, these are all extremely healthy returns. So you would definitely want to make this investment. And finally, at the bottom, we've already constructed some data tables. We cover the construction of these in quite a few of our core courses. As you can see, we are sensitizing the equity value per share by WACC, by the perpetuity growth rate, and by the terminal multiple. These numbers will feed into our football field chart when it comes time to build them. But at this point, you are done with the DCF model. Congratulations. Now let's talk about relative valuation.